We've all heard the buyer's remorse stories over the past few years about how much people really messed up when it comes to buying a home. They paid too much, they bought in the wrong location, the house is too small, it's not in the school district I wanted to be in, my neighbor is scary. Everything in between that we've all heard are all reasons that people have buyer's remorse. However, I want to focus in on probably one of the biggest mistakes, which is paying too much for a house, because that's something that so many people did. You saw people waive contingencies, have no rights to inspect the house, nothing like that, and just pay $20,000, $30,000 over asking price without even batting an eye. And those people now are starting to get what they deserve, because what's happened is so many of those people now are house poor. And in case you don't know what house poor is, it means that you basically overextended your housing budget and now you have little or no money left over for savings or other bills. So congratulations, you got the house of your dreams, and now you're gonna work like a slave for the rest of your life just to keep your head above water, is the situation that these people are in. But it actually gets worse than that, because some people who are in dire straits financially that got in way too over their head are so far deep in debt, guys, that now they actually have to take on additional debt just to pay for their everyday expenses, which is why you're starting to see the uptick in all the refinance applications over the past several months, even though rates are higher than what most people have, because they need that extra money to pay their bills. That's why you see so many people taking out home equity loans and home equity lines of credit to pay their bills. That's why you see everybody going into record amounts of credit card debt right now. The average person is carrying almost $6,000 in revolving credit card debt. That's carrying anywhere between a 20 and 30% interest rate right now, guys. Like, how is that good? Is that all worth it to get the house of your dreams, that you did all of this? To me, that sounds like an absolute nightmare. And we talked a little bit about this in yesterday's video, like people choosing to rent instead, and how some renters are embarrassed to admit that they're renting. I'll tell you what, I would feel much better about my financial situation as a renter, knowing that I got money saved and I don't have any debt, versus one of these people that got the house of their dreams and have a HELOC loan and have $10,000 in credit card debt just to keep up with the bills. Those people right now are the suckers, okay? And I personally think it's a lot of these people who are in this situation right now that we're describing are going to be the main people who are going to be selling over the next couple of years. People that thought that they could hack it, they thought that they could continue making these payments, but now they've seen, their escrow payments go up substantially on their mortgage, and it's like, oh, well, I didn't think my insurance was going to go up by an additional $400 a month, and I didn't think my property tax bill was going to go up an extra $300 a month. So now all of a sudden, I have an extra $700 a month house payment. But my realtor promised that, you're getting a 30-year fixed mortgage. This is a safe way to go. Well, you were lied to, and now it's time to pay the consequences. So how do people end up in this situation to begin with? Well, we already kind of talked about the first way is people overextended their budget, guys. Like, people get a pre-approval letter from their lender for $400,000, and then they want to go out and buy a house for $450,000. That's what people do. Instead of getting that pre-approval letter for $400,000 and buying a house for $300,000. And I understand that there's probably not too many places left in this country where you can buy a house for $300,000 right now, but there's more places than you think are out there. They might not be in the most desirable places, especially weather-wise, but they exist. And the reality is, if you can't find a house that you can afford based on your budget that you like, then you really can't afford to become a homeowner in your area. That's really the simple math. That's how it maths out. People don't want to realize that. They don't want to wake up to that fact. They just want to become a homeowner at all costs, and now they're paying for it. This house was just listed for rent a couple weeks ago for $17,750 a month, and they bought it for $3 million. But look at the purchase history. They bought it for $2.75 million back in 2022, knocked down the house, remodeled, whatever. Then they started to get $4.4 million for the house, and they ended up selling for $3 million, down from $4.4 million. Same thing's going to happen with the rental side of things, guys. These guys trying to get 17 grand, they would be lucky to get 10 or 12 most likely. And look at that property tax bill. jumped from $4,000 a year to now $42,000 a year. Unbelievable. Now, another way that people become house poor, which is kind of similar to overpaying, is you spend more than 30% of their budget on housing expenses. And this is a rule that basically everybody has been breaking over the past few years, except for high income earners. And even then, they can be breaking this rule as well, because we've seen a shocking amount of people has increased that make over 6 figures a year that are now living paycheck to paycheck. And I'd be willing to bet that this is one of the reasons why, because the vast majority of their income is going towards their house payment. They thought they could afford that $1 million house, but it turns out that mortgage payment, along with all the expenses of maintaining that $1 million house, are not as cheap as they thought it was going to be. And also, I don't even understand why the mortgage lenders do this, guys. This is a huge misleading thing to begin with, because all these mortgage lenders approve people based on their gross income. So you're not supposed to spend more than 30% of your gross income on your housing expenses, right? But nobody even knows what their gross income is, because they never see all that money at the end of the day. Your net pay, which is your take-home pay, is the actual amount of money you have to work with every month, which means that your housing expenses, if you're already at 30% gross, are probably more like 40% when you're talking of your take-home pay, guys. And when you round up everything else that goes along with maintaining a house, you might as well call it 50%. So you can quickly see how fast all this can spiral out of control if somebody decides to spend more than 30% of their gross income on their house payment. They're easily really spending 50% of their take-home pay, which shouldn't be allowed, but it happens all the time. That's who all these people are who are house poor. They're gonna be the first ones listing their house on the market the minute that interest rates go below 6%. But here's another big mistake that these people make. They buy in neighborhoods that have minimal liquidity. So what does that mean? It means that you buy a house in an area where homes aren't really selling and there's a lot of inventory on the market. And this is probably the worst situation to be in, because if you overpaid for a house in a neighborhood like this, where now inventory is starting to explode, you can just look at people who bought homes in Austin, Texas is the perfect example of that. These guys are in big trouble, guys. Here we have a house for $3.5 million, and you don't see this every day. This one's actually owner occupied, and they bought it back during the last housing crash in 2007 for $1.1 million. So they probably grossly overpaid for it back then with that timing, and they're just now selling it. Tried getting 3.65, didn't work, so now they're down to 3.5. 6 months later, can't sell the house, and property tax bill here is a little over $11,000 a year. But man, these guys need to wake up and get the hint, because no one's buying it for $3.5 million. Imagine you're somebody that got that 3% interest rate. Congratulations, but you overpaid for the house by $50,000, and now there's more inventory on the market in your neighborhood than there was pre-pandemic. You have lost any equity that you had in that house. Is worth substantially less than you paid for it, and there's no way you can potentially sell it right now for a profit. You're going to be taking a huge loss, which means short sale or foreclosure for you, and it means that you're still house poor. So that's like the worst of all worlds to be stuck in, is somebody who did that. And there are a lot of people out there right now sitting in that position, wishing they didn't buy that house. Another way that people really screw themselves over and become house poor is by getting an adjustable rate mortgage. Now, the amount of people doing this is nowhere near what we saw during the last housing crash, which is a good thing. People have wisened up, but they are still happening. People still get these mortgages, and look how fast the interest rates have changed. Literally from 2021 through 2023, the rates doubled, or more than doubled actually. And if you had an adjustable rate mortgage, you could be screwed, guys. Your mortgage payment could have went up by double, and now you had a house that you thought you could afford, and it's become a house that you no longer can afford. So also, bad situation. And I think one of the most common ways that people become house poor, they don't put enough money down when they buy the house. They don't put a large enough down payment. It's very common for people to put anywhere between 3 to 5% down. If you're using an FHA loan or even a conventional loan, some of them will go as low as 5% down. And if you're at a VA loan, you can put nothing down, guys, and that might be great as far as getting you into the house, but you have no equity from the very beginning. And in a market that we're in right now, there's a good chance that a lot of people who did that have seen their home values go below what they paid for the property. And even if it hasn't, even if it has remained the same or even went up a little bit, by the time you factor in all the selling costs, you're probably still going to lose money. And here's one of the most common ways people get in trouble as well, is people taking out home equity lines of credit. And just like adjustable rate mortgages, home equity lines of credit are variable interest rate debt products, guys. So people who get these think that this is the greatest thing since sliced bread. Well, I'm just going to use this to fix up the house or pay my bills or whatever, and I can afford the payment, but bang, the interest rates go up, and now you can't afford it anymore, you know, or it's just straining your monthly budget to the point where now you're once again house poor, where you're spending too much money on just paying for a place to live. And to me, this is somebody who just shouldn't be buying a house at all right now, but it's somebody who has a lot of other debt. And I would be surprised that people like this could even get approved for a home loan, but maybe they did with a co-signer or something like that. But if you have a lot of credit card debt, or if you have a lot of student loan debt, or you know, a high car payment, something like that, and then you throw in a house payment you can barely afford, guys, like honestly, what's the point of even going through all this? What's the point in working? What's the point in trying to get ahead in life when all of your money is going towards your bills every month? Like, that sounds miserable to me. I would probably rather live in my parents' basement for free than live a life where I'm working 24/7 to just stay afloat, to just pay all the bills and to be house poor. That doesn't sound like a very good way to live your life, if you ask me. So some things that people should be looking at right now, if you are a prospective home buyer and you're thinking about getting into the market this year, is no doubt you should not be looking at anything that you can't afford comfortably, guys. If you're breaking one of these rules that we just talked about right now that has made people house poor, you shouldn't move forward with the deal. And if you do, you're basically a fool. You're getting yourself in over your head on purpose, you know, voluntarily, knowing that it's not the right thing to do, and you're gonna pay the consequences like the others. And so many people are all concerned with like, oh, when are the interest rates gonna go down, you know, because that's gonna make everything better. Well, it's not, guys. It's not gonna make everything better, okay? Has it increased affordability recently? Yes, but rates have not come down much, and part of the reason it has increased affordability recently is because in a lot of areas, home prices have come down. So when you have a combination of lower rates and lower prices, that's the jackpot right now compared to what people were looking at a couple of years ago. But everybody's always asking the wrong question, like when are interest rates going to come down instead of when are prices going to come down? And there's so much bad advice out there, which I continue to see time and time again, because all of the lenders, all the real estate agents are going to always tell you the same thing, guys. Don't wait for interest rates to come down. Buy the house now and you can refinance later. I have made several videos in the past of why this is a bad idea and how it's basically a huge lie that puts people upside down. And you don't want this. You don't want to listen to that advice because it is horrible advice. I'm not going to get into all the reasons here in this video since I've done entire videos on it, but just to give you a quick summary, if you do this, if you listen to people that say buy now and refinance later, there is a high probability that when interest rates come down to a favorable level where it makes sense for you to refinance enough to lower your payment, that your house has lost value to the point where you cannot refinance. That's the most likely scenario that you're going to be facing. But they're never going to tell you that because it's easy to just say buy now and refinance later because you have your hopes set on this house. What people really should be doing is working on getting themselves out of debt, lowering the amount of debts you have, all the debt payments you have each month. Try to eliminate them or lower them, guys, especially when it comes to credit cards. Get rid of those first because they're the highest interest rate debt. But beyond that, if you have a car payment, try to pay it off early. You have student loan debt, try to pay that down as well, because all the debt you can eliminate before you become a homeowner will help you when it comes to getting qualified and increase the amount you will qualify for, because it will increase what's called your debt to income ratio. And just by doing something that simple, just by lowering your monthly debt payments, you can increase how much you can spend on a house in the future, which will also prevent you from being house poor. And I would just encourage everybody to be paying attention to inventory in the areas that you're interested in. Guys, if you live somewhere where you're seeing inventory continually going up over the past few months, that is a sign that there's going to be a lot of opportunity this year and into next year, because it's not common at all for inventory to go up in any market during the winter months. So the fact that it's been going up over the past few months where you live is a big warning sign that there's going to be a lot more where that came from come the spring selling season. So definitely don't feel the pressure to jump in if you see that happening. But say if you're in the opposite situation and inventory is still very low and well below pre-pandemic levels of where you live, you still see home prices going up, I would also be cautious, guys, because how long can that situation go on for? How long can people in your area continue to afford to pay more and more for homes? Is that something that's going to continue to go on forever? Unless you live in an extremely wealthy area, I would say probably not. And even in the really wealthy areas, like here in Miami, for example, you know, we're seeing these sellers here cut the prices of these houses down tremendously, guys. You guys have seen this in several of my videos, massive price cuts, you know, talking $500,000, $1 million off, $1.5 million price cuts like it's nothing. But chances are, if your budget is in the millions, you're probably not even watching this video and probably don't care about any of this because money's not a big concern for you. What about real estate investors? You know, we talked about yesterday how, you know, the amount of real estate investment properties that were purchased over the past year dropped by 30% in 1 year. That's a substantial difference. And according to Realtor.com, the amount of investor purchases at the lowest level we've seen in 20 years now, as of the 2023 data, guys. So I saw this story today that says, you know, if you're a real estate investor today, what, if anything, can you still do to try to make a go at it in today's market? Now, I'm not saying I recommend any of this stuff, but I thought it'd be interesting to point out for anybody who wants to consider these things as an option for them. Now, the first one, which is probably one that I actually agree with, that I think is the best option for somebody who's young that wants to get into real estate investing and single or both, and that is house hacking, because that means you're essentially going to be sharing a portion or your entire home with strangers and renting out bedrooms or things like that. And that's not a very comfortable living arrangement for, you know, a couple or somebody who's older who just wants more peace and quiet. But if you're on the younger side, you don't mind having roommates and you want to get on the real estate ladder, this can be a good way to get in. This strategy comes with the least amount of risk, providing that you can afford to pay for the property entirely on your own. Assuming you have no roommates. Let's say you're getting a 4-bedroom house and you're going to rent out the other 3 bedrooms. You need to be able to afford that 4-bedroom house completely on your own, and that's how this becomes a relatively low-risk real estate investment. Now, the next one is kind of good, but also very difficult to do these days unless you buy houses that are complete teardowns or complete fixer-uppers, which means you need to have a lot of money, and that is like a value add. You know, you're basically buying a tear-down property that needs a ton of work, and you do all of the work, fix it up entirely, you turn around and sell it for a profit. But obviously you need to have a lot of money to do that, you need to have a lot of experience to do that, and that's just not the way most real estate investors should go. Now, this next one I would say is also very risky, is they tell people, well, you can become the bank yourself. If you're sitting on extra cash and you don't want to invest in property yourself, you can loan your money to other real estate investors. And while that can be a profitable thing to do, you know, I see most real estate investors that do that, they'll lend out, you know, 100% interest loans only at like a 10% rate, and they're just collecting that 10% rate all day long. The problem is you have to do all your own underwriting on the deal. You have to make sure that the property you're lending on is secure collateral, guys. If you do this and somebody buys the wrong place with your money, and then you need to foreclose on it because they stop paying, and you're the one who's going to be losing money if you can't recover the money out of that property and sell it for more than what they paid for. So it's a very risky move to do, but obviously only people with big bucks are doing this. Now, here's an interesting one that I kind of like, actually, especially with how weird the inventory situation is out there, and that is this. You can just build your own house or build your own multifamily property. Obviously you need to get a piece of land, but it's almost cheaper to do that now than it is to buy something existing. And The great thing about this is you're going to have a brand new property, and you shouldn't have to worry about too many problems, especially because, you know, the older the building you buy, usually the more problems it has. I've been through this myself as a real estate investor. If you run the numbers, then it actually is more favorable for you to just build a place from scratch as a real estate investor and then turn it into a rental. That could really be the way to go right now, guys, because there's no shortage of vacant land out there for sale. There's a lot of that out there. And if you can build the right place on it and make it profitable, I think that, along with the house hacking right now, are probably the best real estate investing strategies. So guys, bottom line is, be smart. Don't be stupid like so many people that overpaid for houses, and you're in there paying 50-60% of your income each month just to stay afloat, and you have no money left over for anything else after all your living expenses. Just avoid it, you know. And if you are somebody who wants to get into real estate investing, you know, knock yourself out. I think it's still a very risky time to be doing that, but if you're a risk taker and you have a lot of money to lose, then knock yourself out. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.